Hey there everyone, it's Joe from Ainslie's Gold Silver Standard Insights, brought to you by goldsilverstandard.com and ainslieBullion.com.au. Today's topic is what the RBA rate hike means. Now that's posted on the Ainslie website. I'll put a link below for you to follow along. And of course we have Chris Tipper here to break down the morning's news. And joining Chris today is regular contributor and data analyst extraordinaire, Josh Lang. So gentlemen, over to you.
Thanks, Joe. The RBA surprised the markets for the second month in a row with a lower than expected rate rise of just 0.25% against the backdrop of other global central banks continuing to raise at breakneck speed. On the surface, this is good news for people struggling with already sky-high cost of living expenses to not have to budget in even more for loan repayments. The danger remains, however, that if we fall too far behind the rest of the world, especially the US, we'll pay one way or another, with inflation continuing to rise and the Aussie dollar continuing to fall. So today we welcome back Josh, who has been taking a closer look at how all of that fits together through the lens of some of those great charts that we saw in the printed news piece today. So thanks for joining us again, Josh.
My pleasure, mate. Always good to be on.
All right, so let's dive straight in and talk about that rate decision. So 0.25%, the market was expecting 0.5%. And I know we're expecting probably 0.75% from the US Thursday morning, early our time. So what was your interpretation of that? What was that really about?
Yeah, Chris, it was all very surprising. I mean, I was on here last week after we went through Australia's inflation data. I was here screaming, surely they have to increase by at least 0.5%. And here we are with 0.25% as the increase. I found that quite interesting, and I think it's a clear sign that the RBA are beginning to factor in other things such as the Aussie household budgets, which are probably starting to struggle. In their statement, they also said a further increase in inflation is expected over the month ahead, with inflation's now forecasted to peak at around 8% later this year. Then just under 5% next year and 3% in 2024. And another part I noticed is that it seems that the RBA has, like I said, shifted those priorities from doing everything they can to solve inflation, no matter what the cost. And now they're sort of starting to juggle multiple serious economic factors, including household budgets. I mean, even at the end of the statement, they're saying they'll do whatever is necessary to curb it. But my question would be, well, why aren't you doing it now? Why is it only 0.25%? So I think there's more to it if you read between the lines a bit. And even more from their statement, they said the board's priority is to return inflation to the 2 to 3% range over time. It's seeking to do this while keeping the economy on even keel. And the path to achieving this balance remains a narrow one and is clouded in uncertainty. And I don't know about you, Chris, but I found that part a bit concerning. I mean, are they playing this month to month at this point?
Well, that's interesting. And I've been looking at it a little bit as well through some analysis that I've been reading from other people around the world. And part of the issue I see, and you mentioned it before, that the forecast peak is around 8%, but it doesn't just go from 8 to that 2% that you're talking about, right? So you've got, like I think you mentioned before, 5%, you said 5% next year, 3% 2024. Right. That's still not 2%. So we're talking about well into the future before we get anywhere near a number resembling that 2% target. And that's something that's starting to concern me a little bit, because I think you've got markets generally pricing in this idea of a pivot. And I'm increasingly convinced that that's not coming quickly, because those rates are going to stay high rates of inflation for longer, which then gives them leeway, or more than leeway. It sort of necessitates that central banks continue to raise those rates, or at least keep them. They might raise them to a peak, but they're going to probably stay there for quite a while.
Yeah, and we got to remember as well, 0.25% is still actually a large increase in its own right. Yeah. But in the context of what's going on across the world, we're actually falling behind here locally, something which we could see negative effects in the local currency, the Aussie dollar. This is especially the case, as I think you mentioned earlier on, Chris. The Fed makes their interest rate decision, was it Thursday?
Our time Thursday morning.
Our time Thursday.
About 4 o'clock, I think.
Yeah, it's forecasted to be 75 basis points, 3 times what we're increasing here. So I think projecting out that's going to have a huge effect. So right now we're on 2.85 And if that forecast for the US is correct, they're going to be at 4. And that's a big difference.
Yeah, that difference is continuing to expand. And
Hmm.
I actually was quite surprised that the Aussie dollar didn't take a bit more of a hit. It's remained relatively stable after that lower than expected rise. So that's interesting. But apart from that, how else did you see the markets reacting from that news yesterday?
Yeah, I was watching it quite closely when the news came out. The initial reaction was pretty fun to watch in the office here. We immediately saw gold and silver in Aussie dollars jump as the RBA's decision was announced. Gold ended yesterday up about $20 per ounce, higher than where it started. Silver saw an even greater jump as well. And we could be possibly seeing the bottom of that market as it sort of starts pricing in whatever the next phase is. And the reason for this, I think, is, again, the Aussie dollar, which we've covered a little bit. But like you said, the Aussie dollar hasn't really moved substantially yet. I can see it making a move lower once the Fed interest rate decision is set in stone. And that naturally will send precious metals higher here in Australia. It was good to watch as well. The ASX loved the news and opened up with some more gains this morning. I haven't looked since this morning, so I might be wrong now, but it's approaching a pretty critical resistance point. So I'll probably keep watching that one to see if it can break through. If not, maybe we've got further lows to go. But I suppose if I had to summarize your question, Chris, what's in the driving seat at the moment for the market is still, unfortunately, the Fed. The US dollar is still very strong, even though it's come off a bit. It's still very strong. And there's chance for another rally. It could break a high, especially if the Fed doesn't budge and continues hiking really aggressively. I'm also not convinced that we've seen the bottom in equity markets yet too. I know this is probably something you've had on the front of your mind, and I've heard you talking around. You've been closely looking at the correlation between, is it unemployment and the end of a recession market? What have you seen there? I know the RBA statement yesterday said that the labour market is still tight and a lot of businesses are actually having dramas hiring people.
Yeah, well, that was something I was looking at just myself, because I'd gone back and right back to the 60s looking at the US unemployment rate and its correlation to the market generally. And what I found really interesting about that was there was no period of time where the unemployment rate turning up didn't result in from the lows, so turning up. So you think of it like a cycle when you had the unemployment rate at the bottom of that cycle and ticking up, which was usually due to things like central banks tightening interest rates. There was no period where we didn't experience lower lows in the share market after that. So it's concerning me because at the moment we are record low unemployment, and that doesn't seem sustainable against a backdrop of the Fed and other central banks tightening. So the old saying is always, don't fight the Fed. And it feels very much like the market here is fighting the Fed. Well, maybe not fighting, but it's certainly front running the Fed. And the issue I have with that is if you're trying to jump ahead, you're effectively saying that, well, it's all smooth sailing from here. So, forward looking, sure, the market can be forward looking 6 months, but potentially if we haven't even seen the bottom in unemployment yet, and we haven't seen those unemployment numbers start to even tick up, we're probably looking more like 12 months, 2 years away from an actual peak in unemployment. And then that's when you start to see the rollover and the pivot and all of those things that really flood new liquidity into the market. So I'm a little bit concerned looking at that chart and just seeing that correlation to go, well, I think it's probably been a little bit optimistic for people who think it's all smooth sailing here. And it lines up perfectly with what you said before about, 8%, 5%, 3%. Yeah. You're talking years away. And I think the market is looking months away, and those two timeframes simply don't line up. So I think that's a bit concerning.
100%, mate. Yeah, and we've no doubt thrown up the chart for everyone there. The chart there is quite convincing that there's probably more to come here, especially over that longer time frame.
Yeah, and it's easy when you're looking at it every day to think that the market lives in year-long cycles, but when you see some of these things and realize it goes back with much longer cycles at play as well, you do need to factor all that into your decision making. So
absolutely.
Yeah, well, thanks for digging into all of that today, Josh. I know there's a lot of charts and things. It's definitely worth a look. We would have put some of them up in the video, but also worth a look going back and seeing the actual data, I think, on the website. Would you agree?
Yeah, I think the news today we posted did a fantastic job getting all those points across about how this impacts most people. Monetary policy operates with a lag, and that the full effects of it sort of aren't felt until a bit later, especially in mortgage payments, which is a huge thing here. High interest rates, high inflation, it's putting pressure on household budgets. And I think we'll be particularly feeling this coming up to the holiday season. I don't think I can do as good a job as the written news in terms of, the details there, but I really actually would encourage everyone to go have a read of that on our website. But if I had to emphasize the gravity of, I suppose, what it said today, Australia's at record high debt, going through record interest rate increases with more on the way. Wage increases aren't keeping up with inflation. Monetary policy is tightening, and it's not par with central banks across the world. And we're quite possibly looking at still another year, at least, of pain.
And playing catch up potentially as well.
Playing catch up.
Add to that as well. Well, thank you very much again, and we'll go and have another read and look at those charts from the news, and we'll catch up with you again next week to see where we're at.
Great, thanks, Chris.
All right, thanks, Josh. Bye.
Thanks, Josh. Thanks, Chris. And thank you to the audience for watching. Now, if you'd like to continue the conversation with Chris and Josh, head over to the Discord channel. That's discord.gg/gold. They'll be there for the next 1 or 2 hours after the upload of this video. So head over there. It's free to join. You can ask them some questions, get a response, and also tell us your feedback. We really want to hear from you. I always want you to subscribe to the YouTube channel, youtube.com/Ainslie Bullion, for the wide range of informational videos 5 days a week, including weekly Wednesday specials. And while you're on the internet, head over to goldsilverstandard.com. That's bringing gold and silver into the digital world. As we say here at the end, balance your wealth in an unbalanced world. Take care, and we'll see you next time.